Good afternoon, everybody. Welcome back to the Schwab YouTube channel we call Trader Talks. For our next topic, building a stock portfolio. I'm your host, Kevin Horner. I, of course, am a senior manager with the trading education team here, and pleased to be with you all today. Thanks for joining me. So today, we've obviously had a little bit of a volatile market. I'm going to spend some time with a brief review of the market, how we finished, looking at some areas of strength, some areas of weakness, and of course, reviewing our example portfolio for any changes that may have occurred over the last week. There have been a couple that we want to talk about and address. Today, I'm joined by my friend and fellow Schwab coach, Connie Hill, in the chat. Connie is a CMT, a chartered market technician, a fantastic coach, and an excellent individual to have in the chat for us today. She'll be able to answer questions for you that I'm unable to get to, of course, but nonetheless, please feel free to post for the duration of our show. Go about 45 minutes total here, and I'll try to keep an eye on things for you so I can bring your questions to the discussion as always. So with that, we're going to move to the disclosures, get those out of the way, and jump into market review. So first of all, remember that our conversations are exclusively for your information and your education. We do not make recommendations here, nor any endorsements for a specific approach to trading the market. We will incorporate, however, technical analysis in our discussion. As we do that, we're going to be incorporating those ideas, concepts, and strategies that traders might use as they're reviewing the areas of the market. That's kind of the way I like to go about things here. As we review and analyze the market, I try to drop in these nuggets of note as it relates to technical analysis to build the conversation, but also show real examples of those anecdotes and ideas of technical analysis playing out in real time. Additionally, while we will not be likely incorporating options much in our discussion of building a stock portfolio, I do need you to be aware, at least in the instance that we do ever touch on them, that options, of course, carry a higher level of risk, not an appropriate investment for all traders or investors out there. You do need to be familiar with options in order to trade them, of course, which means you need to be prior approved at Schwab. To do so, make sure you go through all of the requisite steps. And if and when we do incorporate option details, I'll be sure to remind you of some of the key details as it relates to the thinkorswim paper money desktop application that we utilize here, because there are some differences. Now, with that, we are going to take a look at how the S&P finished today. And I know it wasn't a fantastic day, but we will take some solace from the fact that our bar on the day, the candlestick we see here, we had a nice weak open that once more got bought up. Now, the level at which we've been really watching support has been this 67.75 up to about 6,800. And we fell through that with some pretty good conviction this morning and managed to rally back above it. And I think some traders are going to take some solace and some encouragement from that. If we looked at how this looks on a 5 or say a 15-minute, one or the other, here's the 5-minute. We've got that clear big gap, and we managed to finish the day inside the gap. So if nothing else, bulls will say, hey, we are okay. We repaired the weakness sufficiently. We got into the gap. Let's see if we can fill that gap with tomorrow's open and potentially get to a new short-term higher high, which is ultimately what the bulls want to see in the immediate future so that they can justify maybe stepping into some of these names that had been working. That's what's really kind of interesting about the day today, is that the leadership all got hit pretty well, at least early, meaning when the selling really got going in earnest, we saw selling in some of those groups that haven't been selling at all. So your leaders, like your precious metals, for example, your staples, everything was red for the better part of the majority of the day. And as we finished, as you can see, when you take a brief look at how things closed out on the left-hand side here, all of our sectors finished the day in the red as well. So we've established some intriguing areas of note. As Zinc is pointing out, we've got the VIX at an elevated level, finished the day up 10%, but we know the ledge to which we've seen rallies and pullbacks in the volatility. So keeping an eye on 28 is absolutely an important idea, I think, in the short run here. And remembering a couple of key details. We have noted that VIX has actually shown a bit more of a clear indication of volatility over the last month or so. Whereas, when we were really seeing the market do well, it was when the VIX was just a non-story for us on a day-to-day basis. And so, yes, there's been elevation here. To what reason? That's obviously, I think the geopolitical concerns in the Middle East are absolutely playing a part in this, as is the year two of an administration heading into midterms. Also a good reason to consider and expect maybe a little bit of an elevated VIX and chop to the broader markets. Let's take a brief look at the NASDAQ 100, which did open weak as usual, but as usual, I mean to say as SPX did today, as we may have expected heading into today. But once more, decent buying, and notice we didn't have an exceptional breakdown here that took us through the 200-day moving average at this point. And yet, I'll remind you, as traders, we need to be considerate of the potential for such a move. I often say, we traders, we have this view that the level of support that we set is the level that matters. Don't buy into your own press clippings. What matters is what the market's going to do. And assume that the level of support that you set is likely to be violated. So look for a level below the level you think should hold. At least look a layer beneath so that you know where you could possibly get a bounce. Maintaining the positions into some of that weakness or expecting short-term lows that exceed where you think you should see things holding up can possibly give you a little bit more comfort, and maybe it encourages you to take a proper position into any of that weakness, meaning perhaps you're saying, boy, I really realize I could see layers much lower than we expect. Therefore, I'm going to take a little bit of action by building cash, selling some of my longs, just so I'm a little bit more comfortable if that weakness, in fact, persists. So be thoughtful about your process. Make sure you have a plan for how you're going to address the potential that what we've witnessed already is just the beginning. That is a possibility. All right. Now, in the NASDAQ, that 200-day moving average, clearly a level of import here on these major 100 in the heavy tech sector, or heavy tech index, excuse me. The Russell 2000 had a rough day today. We finished off almost 2%, 1.75, and we had a nice tail, but notice that's finishing in the red, and we're below the 50-day moving average. So we rallied into it, but we did not finish positively. So we finished red versus the open for the day. We would obviously like to see us get right back up above that 50-day immediately. That would be very important for the Russell and the small caps, but the good news, as I see it, is the fact that while yields were elevated at the open, those yields kind of got pushed back rather quickly. And so there's been that correlation, as you all know, right? That we've had yields rally, therefore weakness in the Russell. That's not a shock. And here we've got Barbara calling out the poorness of the VIX, or pardon me, the RSI, excuse me. That's true. We do see a negative bent to the RSI in the Russell 2000, but we could also point out that we've not made a lower low there. So while price made a lower low in the short run with a trade down to that 25.50 area, low of the day here was 25.50 and 97 pennies. Even though we did make a new low in price, we didn't make a new low in the RSI, at least not yet. So some traders in the shorter run would look at that and say, hey, that could be the setup of a bullish divergence where price has led us back higher first before the RSI can confirm support. That could be the case. We'll see how that plays the rest of the week. But it should be noted that this is an important level with the 50-day moving average and that 2,600 ledge for the Russell 2000. So with that, I do have to point out, of course, we did have some individual positions in our example portfolio that got taken out on us through some of this volatility. We should not at all be surprised by it, but I wanted to review it with you all to speak to some of what occurred and remind you of our process here. So a couple of the things I'm going to do. First of all, I'm going to remind of our process by loading the scratch pad so that we all see the account size that we began with, our tolerance for risk, what we consider to be a full position size in this class, $10,000 as a beginning spot, and how we incorporate an exit strategy on our underlying equity positions that is one ATR, one average true range, below the moving average, the simple moving average that we're working with, or rather the one that the security is working with. So we're going to quickly start with SLB, Schlumberger, in our energy trade. The Schlumberger opened pretty weakly. It also finished pretty weakly here. I believe what we're going to find if I applied my trades would be that this got executed on today's open most likely. So let's see. Yep, sure enough. So we got in at $50, 2 pennies. We got stopped out at 48.78 on 100 shares. We limited our risk pretty well in this case, pretty effectively, I should say, by only losing about $1, 120 bucks on this trade. So we're going to need an energy position at some point. I'm not sure if that's going to be today, but you can clearly see that we lost a small amount relative to our comfort. Remember, if we are building in a 1% risk tolerance, the max amount we are comfortable losing is $1,000. So by losing only 120 on the trade, we've done ourselves a service. We have led ourselves into a trade where risk versus reward was proper. And because we established a good exit strategy, it's never fun to get stopped out, but we lost an amount of money with which we have comfort. That's our goal as well. Yes, we're here to make money, but we're equally concerned with maintaining capital. And that's why the exit strategy applied here worked in our favor. Now, what we'll do on SLB, I'm going to put a pin in this, and hopefully we'll get a chance. Maybe we get a shot at picking this one up at the 50-day moving average, perhaps as early as next week, or perhaps before. The question will become whether we have a chance to discuss it as it occurs, or if it hits the 50-day on a day when we're not holding class. So we'll see how that plays out on Schlumberger. We also, in this space, we had a trade execute last week on One Oak, OKE. We bought at 78.89 and we got stopped out at 80.07. That stop out happened back on the 25th, which was basically the day following our last class, if I'm not mistaken, or maybe thereabouts. So let's take a quick look at OKE. And again, in this case, it worked in our favor, right? Yeah, we got stopped out because of the level beneath us there. That's unfortunate that it rallied off of that intraday low, but that's part of the game. And that's where some, as a reminder, while we are incorporating the 1 ATR, okay, what I'm going to remind you all about is that we are only discussing a process, not the specific detail. So one of the processes is to incorporate average true range and just the measure of the average true range. And so if we set the 20-day moving average today as our strategy, our stop level, we would just look at that amount and reduce it by the amount of the ATR, the average true range, and then we would put our stop there. But some of you might say, noting due to your efforts and you keeping a log of your trades, you might notice that the stocks that you're trading have been getting stopped out at only 1 ATR. Maybe they're volatile. Maybe you need a little more wiggle room. Some might say the ATR plus an extra 25, like a 1.25 of the ATR or 1.5 of the ATR. And some traders who are looking at things on a longer term window, sometimes even 2 times the ATR when setting their strategies, okay? This is nothing more than a way to massage our entrance to positions and our exit strategies. And remember, if we are building out a bigger range for risk, meaning we're willing to lose 1.5 ATR or 2 ATR below the 20-day moving average, well, then it should mean you're owning fewer shares, right? Because if our maximum loss per trade stays constant at $1,000 and we are suddenly risking, instead of $2 of risk, maybe we have to risk 4, then we absolutely have to make an adjustment to the number of shares, right? So this is a good question, Scott. Yeah, maybe it makes sense to incorporate a wider berth with your ATR. But remember, it could also be that instead of the ATR that we incorporate in this class, which is a 14 period ATR, some traders may choose to shorten that up to manage the volatility. So let's talk about that real briefly, because I'm not going to utilize this, but I just wanted to give an example. One way, and this is another adjustment you could make, Barbara, that might incorporate that beta, so to speak, because beta speaking to the volatility of the underlying position relative to that of the S&P 500, maybe the trader instead says, yeah, I want the ATR, but because things are so volatile now, let's change the ATR from a 14 period up here. Let's just make it a 5-day. Now we're only looking at the last 5 sessions, and maybe that is going to incorporate that amount of volatility for you. Okay, so there's another adjustment you can make. Doesn't mean it's right. It's just what it does mean is might need to do a little case study work, right? Maybe make a few changes, use a 5-day ATR instead of the standard 14 for a couple of days to a couple of weeks, see if it works. That's ultimately what we end up doing as traders. It's a lot of, we're going to test and we're going to learn and see if it works for us or not. Ultimately, that's what we're doing all the time. Okay. So let's try it. We'll just as a point of note. Now I'm going to make sure that my ATR goes back to 14 because we're going to stick with a standard viewpoint here to maintain our process. But I should point out the difference was about $1, almost $1, or at least 75 or 80 cents on the ATR of one oak here that we got stopped out on. Okay, so that one worked in the sense that we were profitable. Let's look at Cabot. We just put Cabot on recently. Unfortunately, that one didn't hold. And I say unfortunately because, boy, I am really wondering if we should maybe replace this one. Yes, we got stopped out, but look at the tag of the 50-day. You've heard me say this if you're a frequent attendee to this class. You've heard me mention that we've had a working support against the 20-day moving average with only real minimal instances on a closing basis beneath the 20. And so we were working with the 20-day. But if we wanted to be more cautious, we could have incorporated the 50 instead. We could have owned fewer shares and we could have minimized our risk that way. Now that we've gone and tested the 50-day, if a trader were so inclined, they could start from scratch, brand new trade, use the 72.17 level as the initial stop price, less perhaps the ATR of 246, and make the adjustment that way. That would put them somewhere in the ballpark of what, 69 and change, 69 and a half on a new exit strategy, which would be risking about 5 points to the downside. And then we have to basically define our trend. And, some of you would feel confident by this test today. I'm sure that there are some bulls out there would say, you know what? The fact that it opened weekly, finished strongly above both the 50 and the 200 doesn't invalidate the recent uptrend. In fact, it validates both the 50 and 200 day as moving average support. What's also interesting on this chart is the length of the downtrend. Look at this. This one, we go back to 2 years. So the peak occurred in November of 24, and we just broke the downtrend. This could very well be still the beginning stages of that reversal of trend, right? So maybe that's one to consider, but I'm going to put a pin in it once more because we're not going to revenge trade. We're not going to trade it emotionally. We've already had that experience in this class and we learned something from it. So let's see if this maintains that level. We're going to give it a week. And if it looks still positive and bullish from here going forward about a week, then we can reconsider. Okay. All right. Cost your position price at what you bought, what you sold. Yes, I can do that. Let's go ahead and highlight the fact that I just added in the actual trade price, which is a gear add here, right? So just click the gear and we're going to tell it to show trades. Okay, now you can also, don't forget that it can show you your existing orders, right? Your open trades, and you can have it show you your profit and loss scenario on the chart as well. You can do this for your underlying equities exclusively, your options exclusively. You can have them show both, or you can say do not show. Currently, I'm set up to no show those details. Okay, next up, let's take a look. Oh, Coeur d'Alene. Now this one, everybody, I got to say, I was really concerned. I thought for sure we were going to be stopped out, but we didn't make an adjustment on this stop last week because we wanted to give it an opportunity to move. And boy, did we get lucky, because if we would have pushed this too far up, trying to capture the lows, we could have been stopped out. So, and there's a good chance we still can be from this level. Unfortunately, we've got enough volatility in the market, but we're going to try and capture some of that move. So we entered at around 23, and maybe it makes sense right now to raise this at least a little bit versus the 50-day and potentially the 20-day. So I'm going to ask the class, which do we prefer? Do we like that the 20-day came in play here based on that prior peak, right? We had this prior peak right here. So what we had was a horizontal test of support as well. We also have the 20-day moving average. So we might very well be holding up there. If we want to work with the 20-day, we will take our 20-day value minus the amount of the ATR. We'll raise our stop to there. If we want to work with the 50-day, which is what we used last, we can do the same math, and that'll put us somewhere in the neighborhood of just over 20 bucks a share. So we're going to still be basically leaning ourselves towards the reduction of risk rather than the opportunity to lock in profits with such a trade. But I'd like to hear what you all have to say. There's about 100 of you watching at the moment, so I'm going to take a quick sip of my water and just drop it in here. What do you want? You want the 20-day, or would you like the 50-day, everybody? I'm going to take the majority, and we're going to go with that, do the quick math, and raise the stop. All right, so we've got a quiet crew today. So I see a stop loss below the 50, 20, 20, a couple of 50s. All right, so right now it looks like 50-day is in the lead here pretty clearly, and I think it's one of the wise decisions we could make collectively, because yeah, we've been choppy and the 20-day hasn't held as consistently. The 50 has absolutely been the most consistent, at least going back to when we recaptured it back here. So I think a lot of you are on the same page at the 50-day. Certainly the 20 can work, but it's going to need to get in gear immediately, right? And it's still a little unclear. So this will give us, with the 50, a bit of an opportunity to stay with it. So we'll raise our stop up to 2109, or 2009, pardon me. There we go. And then that's going to be a new exit strategy on our CDE. Again, just a reminder, hey, our goal along the way, yes, we want to make money, but we want to reduce the capital risk that we could have. And so raising our stops will aid us in that. Now, remember, the stop, when it triggers, it becomes a market order. So we can't guarantee a price of any kind anytime that we go about this process of raising our stops, but we're working to reduce our risk through raising the stops this way. So, all right, good vote, everybody. I think we'll see that play out over the next week. Good chance that we'll still be in Coeur d'Alene this time next week. Quick peek on Caterpillar. I don't think we'll make a whole lot of changes here. So far, we've been lucky. And I say lucky because you can see where our stop is relative to today's low. So we were within a few points of that. Good chance for a stop out, but I'll remind you, that's fine. We don't mind getting stomped out. What we don't want to do is look at the risk of being stomped out and decide to reduce the price. We do not make that adjustment. We only elevate stops. We do not reduce them, because that would basically tell us that all the work we did in the beginning was worthless. And I don't believe that to be the case. So that stop holds. We are currently in at 698.74. Today's low was 706, so we had about an 8-point wiggle room there. Not too shabby considering the ATR is about 26.5 on this stock, so it's got a wide berth and it can definitely move. That is at risk for a stop out tomorrow, but we'd like to see if it can just hold here. So the good news is majority of, or the most likely scenario is even on a stop out tomorrow, we would do so for profit. I can't guarantee it, obviously, but we would be likely looking at profits. Now, we did start a new position in Amgen. We're not going to need to make too many adjustments here. As you can see, we've got our stop in. It's about $9 below the 20-day. Let's see if that's wrong. That does not look right any longer. So what happened was we have actually managed to really elevate our 20-day moving average here, everybody. So we're going to raise the stop on Amgen, as it turns out, because we are significantly below the 20-day, but by more than the amount of the ATR. So we want to make this adjustment. So we are let's just do the math on what the number says, 373.97. And then our ATR here is 920. Let's just round that up to 923. So that says we need to be in at 364.74. And we are currently in at 355.71. So we're looking at trying to capture an additional 9 points of upside. So in addition to clicking and dragging the order like we did on the last one, I'm going to right click, cancel, replace, and I'm just going to edit the order down below. And so here I'm just going to put this in as the new stop at 364.74. And we'll go ahead, keep that good till canceled, hit confirm, make sure that that's valid. Yep, that all looks right. And there we go. So we've just literally tightened up our stop on Amgen there. So that just leaves us with hopefully lesser of a loss if we were to get stopped out. Okay, so we've hit the big ones. And then last week, we just put a position on with EXC. Let's take a look here. We may not need to make any adjustments, but we'll look nonetheless. All right, so we've got our stop in below the 20. The 20 is 46.86. Our ATR on this one is just shy of $1. So let's say 45.86, and we are in at 46.18. Now, how is that possible? I must have made some mathematical misstep here last week, because if our ATR is $1.45, yeah, it should be 45.86, and our stop currently is 46.18. Well, we're just going to leave it as is then. We'll look at this one next week, but I would have expected that our 20-day absolutely is elevated. I must have made a mathematical calculation along the way last week, everybody, because we should be looking at a stop that would be elevated because prices have only gone higher over the last week. So in this case, the exit strat, no, that's still, unless I'm thinking about the breakout level, which is possible. I mean, the breakout was 48.50, but that would still mean 47.50 on a 1 ATR below the breakout level. So I feel like I managed to mess that up, but nonetheless, I like the level. It is 46.18. It could be a little bit lower below, to increase the likelihood, but today's tail kind of tells us that we had buyers at this level here around just around 48. Maybe what we're looking at is something that's ready to keep going here. So, maybe next week we get the chance to raise it. We'll hold off on doing that with EXC for now. Okay, now let's, yeah, Wiley. Good chance it's all tacos. It's always tacos, isn't it? At least it is in my world. I'll tell you what, that's one of my favorite things about San Diego. There is absolutely no reason to not enjoy tacos when you're in San Diego. Picked a spot, random, worked out beautifully. A few tacos, some excellent chips and salsa. Great way to have lunch before one of my branch events last week while in San Diego, which was such a good time. All right. Let us talk about putting on at least one new example trade. We've got about 15 minutes to go, and you all know that our process has us trading the leaders, uptrending stocks in uptrending sectors and uptrending indices. Now, we're going to maybe, and I want your input on this again, because I love a class that participates. We're going to talk about some stocks that are not in current uptrends, but might be looking at significant bounces from levels of potential support. Today, we had some leadership in the software space. So software made some moves that got it back above the 20-day moving average. That doesn't mean that everything in this space is going to look good, of course, but I can't run a scan to get some of these better sold off names. So names that you're all familiar with. What about a Microsoft, for example? Well, we're not going to be able to get a Microsoft on our scan because our scan is looking for stocks that are above their 20, their 50, and their 200-day moving averages. So my question to you all today, do we want to do a little bit of bottom fishing for the potential of some decent moves to the upside here? Maybe we're able to capture some entrance into a couple of these bigger names at a low level relative to where they've been. It doesn't mean we aren't incorporating their similar exit strategies. We're going to do the same. But my question to all of you is, do you want to do something a little different than what we've done for the last 2 months, which will give us some trades in maybe a Microsoft, potentially a Palantir, also making a significant move? Now, the difference in Microsoft and Palantir, as you can see, 2 days above the 20-day here on Palantir. Microsoft, however, just today finished above it. Still unclear. Some of you would say, maybe we're not yet there. All right, I'm loving it. Thanks, everybody. So I'm hearing that you all would like to maybe dabble a little in some of these sold off names. Potential exists that software could get a relief bounce. Doesn't mean it has to happen. And we're going to take a low-key approach. But I agree, we can try it and let's see what goes on. All right. So why don't we start with Palantir because of the way that that looks? And I say the way that it looks, it's 2 days above the 20-day moving average. So some of you would call that sufficient confirmation, right? Your view of confirmation might be 2 consecutive closes above the defining moving average. Well, in the case of Palantir, we've been below the 20 basically all year. So we are 2 days above the 20 for the first time this year. Some traders would say that that's the beginning of something more. Additionally, let me point this out. You have a setup of lower lows in price, but the RSI is improving quite nicely, right? So new lows in price, but higher lows in the RSI. Bullish divergence. Does that mean that this 20-day has to hold? No, but it does imply for some, rather I could say, some traders infer that that action, that bullish divergence in RSI, tells them that their lows are well set, and while it could pull back, that it shouldn't make new lower lows. That's one way that some traders look at that. So let's use the ATR and the 20-day moving average as it's currently constituted. And I'll remind us of our process. We're not going to take a full position size on a bottom fishing endeavor, right? We're going to go with it small. So we're not going to risk more than 25% of what we normally would. So $250 will be our risk tolerance. Now that means a small position, but that's okay because we can add to a small position in the future. So our exit from 136.98 will go below it by 757. Again, that's the amount of the average true range on Palantir for the last 3 weeks. Some of you might prefer expedite that ATR, change from 14 to 5 days or something like that. Okay, so that puts our strategy down to 129.41. That's our exit, 129.41. And if we entered at today's close, of 147.22. That's a risk of $17. Let's call it $18 to ballpark it. And that means we can only own almost 14, but more likely 13 shares. Again, small position, but we are process heavy in this class. So we are working to keep this disciplined to what we said we're going to try and do. And we're already changing a little bit of our discipline by kind of bottom feeding here by looking at this. Okay. So again, we scanned. This isn't a scanned company. This comes up because of the sell-off and the potential that we might be getting in at a good level here. But I love hearing, good call, Robert. I totally agree with you. I love hearing from all attendees. I think the more voices we have in these classes, the better, right? It's an ongoing conversation. None of us are going to be right 100% of the time, but the conversation can always be helpful. So here we go. We're going to right-click Buy Custom with Stop. And let's go ahead and since we know we're doing fewer shares than we could, we're going to kick this up to 148 for our entry. And again, that's just what we would call a padded limit for tomorrow's market. So as long as we open under 148 or trade under 148 at some point throughout the day, we'll be able to execute our purchase. Then our exit is going to be at 129.41. And again, we're going to purchase no more than 13 shares. All right, so link those up. There we go. So buying 13 at a price not to exceed 148. Once we're in it, we'll have a stop at 129.41. That is good till canceled, but we cannot guarantee that price. So that's right, Wiley. This is actually incorporating a semblance of the Horner rule in that it is 2 days above the 20-day moving average, not 3, even though some of you would like 1 day above to be your Horner rule. Some of you would say, I need 4 or 5 days for confirmation. This is somewhat of a version of that. So that's how we're building that one, everybody. There we go. All right, so we're in. At least we have the order placed, and we've reviewed a process that can make sense for us. Now, as the trader gets settled in here, and if we happen to see the trade take us through the highs we've made of the last 2 days, this could rally into that 50-day moving average. Some traders would look at that and say that's a good area to just go ahead and take my trade off. I wonder, I'm happy to take profits if we get there. And there's the possibility that this 50 crossing the 200 is notable, and we could easily find this acting as resistance. So plenty of reason for that. But remember, if we get ourselves perhaps back above the confluence of the 50 and the 200-day moving averages, then some traders would say it's time to add to their new position, assuming we get put into this one tomorrow. Okay, so campsite, let's talk about that briefly. I've got the time since we've got a minute or two here, and as we head towards the end of the class. I would like to know why the notion of putting options, as in not being the holder, is bothered to be described at all. Well, so actually, I need a little clarity. I thought I was reading that as why not discuss the opportunity to protect our downside at the same time, meaning owning the stock and buying a put. So that is to say, buy the stock and link up at the exact same time with a long put contract to protect one's downside. That's otherwise known as a married put. Largely, I mean, this can absolutely be occurring, and it can be part of a strategy, but it also increases cost. Commonly, traders will look to incorporate put options around known events of risk. So if the trader were in fact to be a buyer in advance of a known risk event, then yes, they may very well incorporate a married put. buy the stock and simultaneously own a put contract with it. That's a possibility. In our instances, we're not going to lean that direction as heavily. I want to lean into building a portfolio of underlying stock that's going to allow us to hold as long as possible. Anytime we tend to incorporate options in the process, especially when we are sellers of options with our long positions, it tends to play a little more on our emotions as the holders of the security. Not as likely to, like I said in the kickoff of this class, not as likely that we incorporate that, but it is a possibility that we'll see some instances of that going forward. Now, we have only 5 minutes to go. So I wanted to, instead of placing an example trade in our final 5 minutes, I wanted to give you a quick look at the couple of those groups that have still been trending, excuse me. So I pulled up the material space. Remember, we got stopped out of our material position, Cabot, and I pulled that up and did a little review today. There's been some discussion of fertilizer stocks. These are seeing a fair bit of elevation due to some shipping issues. But I also noted the LYB, Lyondell Basel. Now, I'm probably not pronouncing that entirely accurately, but the reason that this one popped up for me was because of that 20-day moving average again. We talked about the importance of trying to find your entry opportunities when we've made the turn. And when you look at LYB, this is a pretty good downtrend. This is the 2-year look at it again, right? And if we just drew a line from when we peaked in September of 24, we basically waited until right about January to break that long range downtrend, right? And now we've broken it and have been above the 20, the 50, the 200, all of them. Now, this is an improving bit of action in a space that has been providing leadership. This chart kind of spoke to me a little bit. I wanted to build the trade around it, but we're short on time. So we won't, but I'm going to make sure that it is a noted position for us to look at next week, because we may very well be able to put this one on there. Now, as an example, some traders, you'd look at the 20-day here and you could easily validate going with an ATR below the 20-day moving average. Some of you might say, yeah, but look at the 50, it's getting caught up. We've got enough volatility that maybe it'd be more considerate to go with the 50-day moving average level and an ATR beneath that. Either way is fine for a trader building out an example opportunity like this. But as always, you need to make sure you do the math and you're sitting on the proper number of shares that will allow you to manage that trade appropriately, right? So as always, that's a key consideration. All right, so we're just about at time. So let's wrap up the conversation briefly. We looked at, we obviously reviewed the broader indices for the changes for the day. We had weakness in the morning, followed by buyers stepping in the late morning, bringing us through lunch and improving the way things finished versus where we started. We've reviewed our existing portfolio for the changes necessary. We raised some stops. We made note of the fact that we got stopped out of a few individual positions, and we're kind of setting the table for next week as well. We will come back, revisit. Let's see if we put ourselves into the Palantir trade, which I'll remind you all once more, was not how we normally do things in this class. But I'm trying to be a little bit nimble, and I loved hearing from all of you that you wanted to take a little bit of a flyer, a little bit of action, different than what we've done. And if nothing else, I hope that our process speaks to you in terms of building an example trade, knowing your risk, proper number of shares, having all of that process built in is absolutely paramount to the trader. So hopefully this was a helpful conversation today. So with that, I'll thank you all for being here. Make sure you're following Connie and me on X, Connie Hill CS, Kevin Horner CS, and if you don't mind, hit that thumbs up for me down below. We're going to get this, of course, reviewed by compliance into our archive. and available for replay. And that thumbs up helps us out a ton on the replay. And of course, don't forget, make sure you're subscribed to the YouTube channel we call Trader Talk. So with that, I'll wish you all a great rest of your Tuesday. I look forward to catching up with you again real soon.